Are you ready to dive into the story of a rapid rise and sudden fall of one of America's most influential banks? Hey everyone, Trish here. Today, we're going to unravel the intriguing saga of Silicon Valley Bank, a financial institution that emerged from the heart of innovation and entrepreneurship. As we're about to discover, even the most robust banks can succumb to unforeseen challenges. Founded in 1982, Silicon Valley Bank was established with a clear mission to help startups struggling to secure funding for their novel ideas. This unique endeavor was initiated by a visionary Stanford University professor and a group of executives from Wells Fargo. As years passed, the bank's growth skyrocketed, particularly during the dot-com bubble, cementing its role in the high-tech sector. Its triumph was built on a foundation of providing bespoke financial solutions to venture companies, recognizing their unique risks and proactively addressing the needs of its clientele. However, the bank's bankruptcy was a sudden and unexpected development. If you find this video interesting, it would be great if you could support us by hitting the like button. Now, let's get started. Let's delve deeper into the events that unfolded, leading to the dramatic collapse of Silicon Valley Bank. The bank's initial success was fueled by its novel approach to nurturing ventures, particularly during their early stages when funding was often tight. This approach was specifically designed to serve the unique financial needs of venture companies, giving Silicon Valley Bank an edge over traditional banks. The year 1982 marked a pivotal moment, with the formation of Silicon Valley Bank shares. This move laid the groundwork for the birth of Silicon Valley Bank. Just a year later, the bank's growth trajectory was nothing short of impressive, and by 1986, it acquired a bank in Santa Clara, expanding its reach and influence in the financial landscape. After establishing a strong foundation, the bank took its first big step towards expansion, with its initial public offering in 1988, managing to raise $6 million in capital. While this amount may seem modest for a bank, Silicon Valley Bank had grand ambitions to support the rapidly growing venture ecosystem in the Silicon Valley region. It was during this time that the bank decided to venture into high-risk real estate lending, a decision that would have significant implications in the years to come. As Silicon Valley Bank moved into the 1990s, it faced a complex mixture of opportunities and challenges. Its real estate lending business reached a substantial portion of its portfolio, reflecting the bank's willingness to take calculated risks to support its clients. However, with the real estate market's inherent volatility, Silicon Valley Bank had to navigate through a minefield of potential financial pitfalls. To further strengthen its foothold in the venture industry, Silicon Valley Bank made a strategic decision to diversify its offerings. In the boardroom, executives were aware that depending too heavily on a single industry, no matter how thriving, exposed the bank to significant risks. They chose to broaden their risk profile and cater to new sectors, adding winery lending, providing loans for winery development and operation, and venture capital financing to their portfolio. This decision wasn't made lightly, but with careful deliberation and a vision to offer a wider array of financial solutions to clients. Let's take a closer look at how these new sectors helped bolster the bank's position and the challenges they presented. This strategic move allowed the bank to capitalize on the booming tech industry, particularly during the dot-com bubble. As technology companies experienced unprecedented growth, Silicon Valley Bank found innovative ways to support them. This included tailoring loans to the unique needs of tech startups and providing crucial venture capital. The bank also fostered valuable connections, linking these burgeoning companies with potential investors and essential business services. The dot-com bubble's eventual burst in the early 2000s brought significant challenges to Silicon Valley Bank. While some might have expected the bank to contract, it surprised everyone by expanding its presence internationally. It set up operations in key global tech hubs like London, Beijing, and the Silicon Valley of India, ensuring its continued relevance in an increasingly interconnected world. As Silicon Valley Bank continued to navigate these turbulent waters, it solidified its reputation as a crucial player in the venture capital ecosystem, serving as a catalyst for innovation and growth in the technology sector. Its success was fueled not only by financial acumen, but also by its ability to foster connections and partnerships within the industry. Fast forwarding to 2008, the global financial crisis hit, proving to be the sternest test yet of Silicon Valley Bank's resilience. The crisis, triggered by the burst of the housing bubble and risky lending practices, sent shockwaves through the global economy. With the subprime mortgage crisis unfolding, financial panic gripped the world, and Silicon Valley Bank found itself grappling with a rapidly deteriorating economic landscape. No sector was untouched, including the once booming tech industry, which saw a sudden drying up of venture capital. Silicon Valley Bank faced the financial crisis with determination and strategic agility. Recognizing the profound impact of the crisis, they took action to weather the storm. This included receiving a $230 million loan from the government under the Troubled Asset Relief Program, a crucial lifeline that helped prevent a total collapse. Beyond that, they implemented stringent cost-cutting measures and refined their focus on more stable sectors. They also bolstered their risk assessment and management practices, a necessary adaptation in the face of economic upheaval. While the bank managed to survive the crisis, it was not immune to the challenges that lay ahead. With the economy in turmoil, the landscape of the venture capital world underwent significant changes. Yet, Silicon Valley Bank persisted, adapting to new market dynamics and leveraging its vast network to support emerging ventures. Throughout the following years, the high-tech sector experienced unprecedented growth, with a torrent of capital flowing into Silicon Valley. As a result, Silicon Valley Bank's revenues tripled over a decade, and its deposit volume increased almost tenfold. This remarkable growth further solidified the bank's status as a major player in the United States financial industry. Moving forward to 2015, a year of jubilation for the bank, as it accomplished a milestone, amplifying its commanding position in the venture capital sphere. Silicon Valley Bank proudly declared that it served an astounding 65 of all venture companies in the United States. To put this in perspective, imagine that out of every 100 venture companies, 65 were banking with Silicon Valley Bank. This extraordinary market share demonstrated the bank's deep and significant influence on the core of American entrepreneurship. One of the crucial factors contributing to Silicon Valley Bank's strength was its ability to forge meaningful connections between its clients and various stakeholders. Critical to their success, the bank acted as a bridge, linking ventures with venture capitalists, law firms, and accounting firms, essential components of a thriving entrepreneurial ecosystem. Moreover, Silicon Valley Bank displayed a keen understanding of the unique risks associated with startups. Unlike traditional banks, it recognized that many startups might not have substantial sales or profits initially. Despite the uncertainties, the bank was willing to provide loans to promising ventures, supporting their growth without the burden of relinquishing control or sharing equity. Furthermore, Silicon Valley Bank demonstrated its flexibility and willingness to work with entrepreneurs during challenging times. As the venture landscape's fast-paced nature meant rapid changes in business conditions, the bank responded with tailored solutions, such as postponing principal payments or providing lump sum repayments when appropriate. Apart from its financial services, Silicon Valley Bank went the extra mile in supporting its clients. Beyond traditional banking services, the bank extended housing loans to entrepreneurs, a rare offering that catered to the unique needs of the venture community. Venture capitalists recognized the added value of banking with Silicon Valley Bank, and it soon became standard practice for them to require their portfolio companies to open accounts with the institution. This widespread adoption further solidified the bank's position as the go-to financial partner for venture-backed companies. By the turn of the millennium, Silicon Valley Bank had become the 16th largest bank in the United States in terms of total assets. Additionally, its parent holding company, Silicon Valley Bank shares, made its mark by joining the prestigious S&P 500 index. These accomplishments reaffirmed the bank's status as a major financial institution, entrenched within the fabric of the American economy. As venture capital investments continued to flourish, especially in the booming tech sector, Silicon Valley Bank stood at the forefront. Holding more than half of the venture capital invested in startups, the bank was effectively sitting on the board, as its support and financial services underpinned the success of countless startups. However, as history has shown, even the most prominent institutions can face unforeseen challenges, and Silicon Valley Bank was no exception. The COVID-19 pandemic in 2020 brought a wave of uncertainties to the global financial landscape, prompting the United States government to enact monetary easing policies to stimulate the economy. The flood of capital from the government's monetary easing measures triggered a surge in venture capital investment, resulting in a substantial increase in deposits at Silicon Valley Bank. Armed with an abundance of funds from the influx of deposits, the bank intensified its strategy by investing heavily in holding-to-maturity securities. While this seemed like a prudent move to ensure steady returns, it also proved to be the Achilles heel when interest rates began to rise in response to the subsequent inflation surge. Venture capitalists, cautious of potential market instability, quickly withdrew their funds from Silicon Valley Bank, setting off a chain reaction of deposit outflows. The bank found itself facing an acute liquidity crisis. Its considerable holdings of holding-to-maturity securities, which had once been considered safe assets, turned into an obstacle, as they could not be readily liquidated to meet the surge in withdrawal demands. This crisis underscored the inherent risks all financial institutions face, regardless of their prestige, when navigating uncertain times. In the face of an acute liquidity crisis, Silicon Valley Bank scrambled to raise funds. They attempted to sell off assets, tighten credit conditions, and even negotiate potential bailouts. Yet, the sheer speed and scale of the crisis overwhelmed these efforts. The situation was further exacerbated by credit rating downgrades, which ignited investor panic and accelerated the bank's rapid descent into bankruptcy. The bank's heavy investment in holding-to-maturity securities, initially seen as a safe and steady income source, now proved to be a liability. It locked a significant portion of their assets into a form that could not be readily liquidated to meet the sudden surge in withdrawal demands, further compounding their liquidity crisis. Within a mere 2 days, a staggering 80% of its total deposits, a sum nearing $142 billion, largely constituted by the earlier increase from the government's stimulus funds, were withdrawn, pushing the bank to the edge of collapse. The situation was unprecedented in its speed and scale. Greg Becker, who was the CEO of Silicon Valley Bank at the time, described the intensity of the crisis, stating, "It's hard to imagine any bank being able to withstand a run on deposits of unprecedented speed and scale, with deposits being withdrawn at the rate of about $1 million per second." In conclusion, the demise of Silicon Valley Bank serves as a cautionary tale about the importance of managing liquidity, risk, and maintaining a balanced investment portfolio. Despite its remarkable growth and influential status, the bank's over-reliance on holding-to-maturity securities and its slow reaction to shifting market conditions catalyzed its swift descent into bankruptcy. From being a pioneer in supporting startups to struggling with financial instability and ultimately filing for bankruptcy, Silicon Valley Bank's journey underscores the vital importance of prudence and adaptability in the dynamic landscape of the financial industry. Thank you for watching. Don't forget to like, comment, and subscribe for more insightful content. Take care and see you in the next video. Goodbye.